Hey guys, it's almost 9:30, so we will start in about 1 minute. We're just kind of letting people kind of feed on right now. So what we're gonna be doing just today, again, just like the previous months, just a quick market update. Kingston, which Pierce County with the Tri-County market. We're gonna recap 2022 a little bit more, rather than the monthly breakdown. So we're just gonna kind of take a look at what happened over the last 12 months with the median home pricing, inventory, and just kind of all the values. But we will let people kind of log in for a little bit longer. So we're going to talk for 30 minutes just about the market, and then we'll update. Then we'll open up for 30 minutes on questions or however many questions you guys have, and then we will get on with our day. All right, guys. So we're gonna get going. It's 9:30. And for those who maybe are hopping on a little bit later too, we'll have this recorded and it will be on the Project RA YouTube. So by all means, you can kind of recap on that. So let's talk about 2022 and what kind of happened this last 12 months. It's been a lot different than what we've been dealing with for the previous 12 months. But before we do that, just for everyone that's logging in, quick background on myself. I've been an active real estate investor in the Pacific Northwest since 2006. um, we kind of built our brand and our names in our local market as the recession flippers. We flipped a lot of homes. I would say over 100, 150 homes from 2008 to 2009. And then we kind of built our whole business, Heaton, Dainard real estate, on investment purchasing for small and large investors, evaluating assets, putting together strategic plans, and then helping our clients implement that plan all the way through. Um, so we were very active guys in the Pacific Northwest. Since we got involved, me and Will, my business partner, have flipped over 2,000 homes in our local real estate market, and we've done over 3,500 transactions. So we're a very active real estate shop in the Pacific Northwest, and we've done over $1 billion in direct sales to investors. Our whole business is built on servicing investors and getting them kind of what they need as far as discounted property resources and the right plans to kind of be able to optimize these deals. So if you haven't been to our office at Heaton Dinner, definitely come by, check us out. We'll sit down with you and kind of go over your goals. So what we're going to cover today, we're going to do a 2022, not 23 wrap up. We're going to talk about Kingston, Snohomish, and Pierce County. We're going to talk a little bit about Washington State in general. And then we're going to cover interest rates, inflation reports, and then investment trends that we're doing right now in this market. There actually has been some fairly good buys, different types of buys over the last 6 months. But stuff that has been historically over the last 24 months very expensive has came down quite a bit, like 30, 40%. So there's been some good opportunities in the market. So let's cover just the Washington State summary real quick. And you guys, I kind of fly through these because Washington State has so many different price points, so many different types of areas that if you look at it, the whole state, it can not it doesn't necessarily mean that you're getting the right data. So we're going to really focus on those tri-counties. But to kind of let you guys know how the state did in general, is the median home price right now is at 553. That's down 1.3% year over year. So we did see a decline finally. And also one thing I want to point out is the high median home price in May was actually at 655. So depending on when you bought your deals or what kind of deals that you're in, that's where we've kind of seen this big pullback. Not from year over year, like a drop of 1.3% is not the end of the world, but off that high median home price, we've seen about a 15 to 20% correction off that. And it's been very sudden with the rates being increased as quickly as they have. Homes for sale or inventory in general is up 30.3% year over year. And then homes for sale, homes that sold under list year over year is 19.7% of homes sold under list this year, which is a 30% drop year over year. So we're seeing a trend of where we saw this first 2 quarters where it was razor hot. It was just extremely hot. The market was hockey sticking up. And what we've seen is the rates have been increased because they've increased the rates at the fastest level that they've ever done. We've seen this decline, or I don't want to say decline, but more of like a deflation of what we saw in the spring, because the spring was going up, in certain markets like Bothell, Kingsgate, or these kind of submarkets were appreciating at 10 to 20% per month. Like I know Bothell in May alone went up like 18%. And so what we've seen is the brakes got hit with these interest rates, and it just kind of has deflated back down. And we're at really 2021 pricing right now, which is still a lot more elevated than it was in 2018 and 19. Average days on market are at 17 days. That's up 8.8 days year over year for the Washington state. Now, once we dig into the Tri-County, it actually has a little bit different story, right? And the reason being is King County's, Snohomish County, those are two of our more expensive counties in the whole state. What we've seen nationwide is this deflation of these expensive markets appreciated so fast, Seattle, Austin, Scottsdale, San Francisco, that those are the ones deflating the quickest. So like if we look at Washington state overall, there's a lot of different median home pricing. There's a lot of different pricing in different sections of the state. It's less because there's a lot more affordability throughout the whole state. The overall decline is a lot smaller. But what we've seen in King County is the median home price has fallen to 729 off a peak of over 880. That's a 3.3% year over year decline. So this is the first time we've seen this decline in, I think, 5-6 years, or since 2018, that spring kind of declined back a little bit. So we are seeing that kind of pullback. We've seen, and that's off median home price. So like off that peak price, we're still down about 15 to 20% that we'll look at in a second. Pierce County median home price now is back down to $495. I think it was around $550 at the beginning of the year, or at the peak of the market. And that's a 1% year over year decline from last year. Snohomish County median home sales prices landed at $666, which is a 2.75 decline from 2021. So let's dig a little bit deeper into each specific county. So King County, like we said, was down 3.3% year over year. The median home price is now sitting at $729. In May, the median home price was $880,000. So that's that same big drop that we were just talking about. These markets, or these segments of the market that have a little bit higher median home prices, or a little bit more expensive in general, the cost of money has been increased about 40% in the last 6 to 7 months. And we've seen about a 10 to 15% decline from where that kind of peak pricing was. So if you really think about it, it's not as actually bad as it seems. If the cost of money is up 40%, we probably should be seeing a bigger decline than what we're actually seeing, but it has pulled back. Number of sales, and this is kind of a big deal for investors in general, the transactions have just slowed down across the board. If you talk to title companies, escrow companies, loan officers, brokers, the market is deflating right now, but it's also because there's just not a lot of transactions going on. The numbers of sales from last year is down 45%. And so things are selling. It's just taking longer. There's less buyers in the market, and things are absorbing a lot slower at this point. That has also caused days on market to increase nearly 25. So it's up to 32 days. At the beginning of the year, we were at 7 days. So that's a 25-day increase in a 6-month period. That's actually, even though 32 days is a very healthy day on market, statistically, days on market, usually if you're selling a property, like back in even 2006, 7, 8, it would take us 30 to 45 days to sell a house. In 2008, 9, and 10, it would take us 60 to 75 days to sell a house. And those are actually fairly normal days on market. Selling a home in 6 days is not normal. And so what we're seeing is the market getting more normalized with the days on market. Percentage of list on average in King County ended that most homes were sold 10% under list. Now, one thing to look at on that statistic is a lot of these homes were also priced substantially higher than what the median home price was, with growth already in there. So it makes sense that they kind of came down 10%. Like I remember when we did our presentation in July, the amount of transactions in the sales were down, or the median home price was down on closed sales. But if you looked at inventory and what was available on market, it was up 10% year over year on pricing. So what's happened is with the rates going up, sellers are coming down, or they kind of were a little bit late to the game and they're pricing heavy, and they've had to do price corrections to get their property sold. And so at the end of the year, we are closing out about 10% off list, and then inventory is up 320%. So we have less buyers in the King County market. We have higher pricing. We have more expensive money, and we have less transactions going on. So all these things are going to increase the days on market. Pierce County median home price is down to 499, which is it's a negative 2.9% year over year growth from the previous year. In May, it was at 575. So again, that's that roughly about 15% decline off that May pricing. So if you bought a deal at the beginning of the year, it's not that fun right now. But we are seeing things kind of leveling out. If you look at that drop from May to now, that's a 15 to 18% drop. Overall, it's actually, with the cost of money, it's not that bad. We're down 3%, and we're seeing pricing now start to level out across. It really comes down to what's the pricing and where the rate's at currently, because the rates are kind of moving around about a half point basis. But things are selling. It's just selling for what people can afford them for. Number of sales decreased 50% year over year. So again, less buyers in the market. They're being more selective, and they're just taking longer to sell. Days on market have increased from 10 days at the beginning of the year to 40 days. So that's a plus 30-day increase. That's pretty large. But again, a 40-day day on market is actually fairly healthy. Percentage of list on average, they sold about 8% off list, and inventory is up 240%. So more inventory, less buyers. That's just going to mean longer sales at this point. Actually, not even longer sales. I would say more normal selling times over anything else. And then to wrap up with Snohomish County, the median home price is now at 661. In May, it was at 790,000. So about the same kind of decline. And you'll notice between the three counties, they're all about 12 to 14% off that peak May pricing. That's telling us that it's really not the housing market that's really getting this dropping. That's why I don't think there's a crash coming on. It's just a cost of money thing. It's very consistent all the way across the board for the consumers that the cost of money being up 35 to 40% has pulled the values back about 12 to 14%. As investors, we're always looking for trends. And basically, if we're looking in all three counties and they're all kind of reading the same way, it allows you to kind of track it a little bit better and go, okay, this is just it's across the board thing. It's not just a specific city. So no county is better than others. It's just a matter of what counties kind of you're working in. So median home price, again, at 661, it was in 790 in May. Inventory is up 275%. Number of sales decreased 42% year over year. So the amount of transactions have fallen by about half as well. Days on market are up, just like King County, up 25 days. It was at 6 days at the beginning of the year. Now we're averaging at 31. And then percentage of list, or we are selling at around 8% off list, and inventory is up 290%. And one thing to point out with these inventory guys, 290% seems like a big number. It is. It's a trend that we have to watch, but we only had like 2 weeks of inventory in the market at the beginning of the year. That is unhealthy. That causes hyper appreciation like that we saw. So if it goes up by 300%, we're talking about 6 to 8 weeks worth of inventory in the market. That is not out of whack. That's actually more leveled out, healthy market. Where you really start to see declines is when the average inventory, or the supply of inventory, gets around that 4 to 5 month period. So what that means is if inventory goes up right now to 4 or 5 months worth of supply, that means that it would take 4 to 5 months for every home to be sold at that time. So that's the absorption rate. So we're seeing the trend is the absorption rate is slowing down. Selling in 6 days, not normal. But now we're around that 6 to 8 week worth of supply in the market. But we're still a long ways away. We'd have to almost double where we're at now to get that really big decline. And so watch the inventory. If you keep seeing it increase up to 4 to 5 months worth of supply, then we could really start seeing the waterfall over. What we're seeing is that's not happening. Is there still not enough inventory in the market? The stuff that's not selling is stuff that's kind of priced heavy, that's kind of average at best. And there's a lot of weird stuff in the market. Homes that are priced right and that are done correctly as far as renovation or being presented correctly are selling. And they're typically selling in about 2 to 3 weeks right now in the market. the buyers aren't jumping on things, and the multiple offers have slowed down because unless it's a deeply discounted property. But buyers have time. They're taking their time. There's a lot of new people coming to our market, and they're not rushed to put that offer in. So having this 6 to 8 weeks, if you're on market for 45 days, that's okay. It just takes time. Buyers want their time to look at things. But keep your eye on that inventory. If it keeps going up, that's where you want to start kind of getting ahead of the price adjustments. So our listings, we're averaging across all boards, and we have about 65 listings in Kingstone, which is Pierce County, is we average about 2 to 3 showings a week. If we are getting 2 to 3 showings a week, we're not as concerned on the pricing right now. Once it starts dropping to like 1 to 2 showings a week, that's showing us that our buyer demand's a little bit weak there, and we kind of want to see that 2 to 3 a week showing. If we're getting that, typically we're selling the property within a 14 to 21 day period. Currently, we have 37% of our properties pending. We've been averaging more 50 to 60%. One of the reasons we're at 37 is a lot of our clients brought a ton of homes on in the last 10 days. So I'm not as worried about that. On average, the last 6 months, we've been able to get most of our homes sold within about a 35 to 45 day period. And we typically stay about 60% sold at that point. And then on average, when we're selling, a lot of our clients that are selling fix and flip property or development, we're trending about 5% off list on most of our product. The reason being it's about 5%, which is a little bit higher than the average, is because a lot of our product is investors that have stabilized them. They put a lot of money in these things, and they're pricing at the upper echelon of the pricing. Now, because it's on the upper echelon and the cost of money is so high, that causes things to slow down. So you either have to kind of be prepared and wait for that right offer, or you have to kind of wheel and deal because you're on the highest side. Our product typically is one of the nicest product in the market. And so because it's the most expensive, but the nicest thing, there's going to be a less buyer pool there. And so just really watch your showings, try to stay ahead of those showings, and don't cut price too fast. Just stay with what's going on. Also, keep your eye on any product that's listed in the market because that's showing you where your buyer activity is. If we have a property that's listed for 1.3 million and there's a bunch of pendings going on in that 1.1 to 1.2 range, we're going to want to try to get more into that range because that's showing us where the masses are. And as long as you're pricing to where kind of the activity is, you should be able to sell it fairly quickly. So what is going to make these rates stop getting increased? Now, the Fed is saying that they're slowing those increases down, but the two things that they're really looking at is the labor market and also the inflation forecast. So the good news is the trend inflation is still way up, but the trend is showing that it's slowing down and starting to decline. So the inflation rate fell again in December to 6.5% on an annual basis. According to the Consumer Price Index, that's down from 7.1 in November. So we're seeing that trend. The peak of inflation was in June at 9.1%. And that was also when the market really stalled out. Like I know I listed a couple houses myself in June and it was dead on the market. We were not getting a lot of activity. So as things start to get kind of leveled out and we're getting away, as the inflation's improving, the Fed is slowing down, how many rate increases they're doing or the size of them, you can see the market just start normalize out as well. So keep your eye on that. But we're seeing that the market is kind of moving with this kind of inflation numbers. The more that this falls, I think the target rate that the Fed's trying to get to is about 3%. So all these rate increases are going to slow this down. And once we keep falling to 5.5, maybe 4.5, we could see the rates to start fall as well. And then one quote I kind of wanted to talk about was Mark Zandi, who is the chief economist at Moody Analytics. And you guys, Moody is one of the best data sources that you can get any kind of trend information for. He feels very good about what's going on right now. He says inflation is on its back heels. It's moderating steady, and at this point, quickly. And so that's that trend that's going to show us more recovery. So if if you got some product that you're thinking about keeping, or you're not quite sure what to say because your values are down, if you can refinance that product, keep it for a year, then resell it, you're probably going to do a lot better than what you will if you sell it in the first kind of 2 quarters. So interest rate review. So as we can see, inflation is slowing down. Good news. Now, as it slows down and hopefully the job market kind of loosens up a little bit, we're going to see the rates and the increases kind of slow down as well. So currently, we're about a 40% effect on affordability from where we were at beginning of the year. So that's a pretty dramatic increase. That's why we've seen it kind of stall out. The federal funds rate currently right now is at 4.5%. That's a huge increase from where we were at the beginning of the year. That's the highest that it's been in over 15 years. So there's going to be some kind of fallout of that. Today's because of what the rate increases, homeowners were getting around three, I would say low threes to high threes is their mortgage rate at the beginning of the year. Right now, the average cost of rates is about 6.25 to 6.5. There is some jumbo product now in that fives though. So the money is getting cheaper. I remember back in the summertime, the rates were going up into the sevens. If you're an investor, typically you need to add about a point to that. So for your single family rental product, you're going to be around 7.5% to kind of get that loan locked in. Look into other types of products that are out there, though. If you're buying a BRRRR property or a short term or a rental at this point, you can get interest only. You can do 2 years. You can do them fixed for 2 years. There's all different ways based on what you think is going to happen with the rates that you can kind of put together your loan and drive down your interest rate. A lot of what we're trying to do right now is target properties that we can almost break even on that have big upside, because we know once those rates start falling into that low fives, it's going to dramatically increase our cash flow. So just look for the financing that's going to get you through that 2 to 3 year window as rates kind of get settled down, and then you can refinance it out in about 3 years and really get that cash flow increase. So the 10-year the 10-year treasury rate is at 3.55. That's a good sign. About 3 months ago, about 90 days ago, the treasury yield jumped above 4. That's not good. That's going to cause rates to continue to go up, and it's going to cause imbalance in the market. So the fact that it's kind of hovering at 3.55 again is showing more stability. Stability is good. Um, and what they're forecasting is they think that the federal rate is somewhere between, right now it's at a 4.5 to 4.75. By the end of this year, they're thinking it's going to be around 5.75%. So they are going to continue to increase that federal funds rate, but it is slowing down. We're not going to be seeing those big 3/4 point hikes. Now we should be entering when Mr. Powell comes out and talks and ruins our day. We should be hearing more about a 1/4 to half point increases rather than those big ones. So these smaller increases, it's going to slow things down. The banks are going to be a little bit less worrisome, and so they can actually. So what happened the last 90 to 120 days is the banks saw this going on, and they were getting a jump on all the rates. They were actually increasing the rates faster than what the Fed was doing. Now, as it's getting more stable because they know kind of a little bit more what's going on, they're doing the rates are kind of starting to come backwards a little bit. So we should see some uh, further uh, rate relief in about Q3 to Q4 of this year. So they're going to increase a little bit more, and then it's going to kind of get itself down to normal, or not. I would say historically normal. We're never going to 3% won't ever be normal again. And then Freddie Mac forecasts that the average 30-year mortgage rate is going to be about 6.6% in Q1, and they're thinking it's going to be around 6.2% in Q4. So Freddie Mac's also kind of predicting that it's going to keep kind of spiking up, and it's going to start leveling out in Q4. A lot of people are saying that they think the rates are actually going to be in the mid to high fives in Q4. And if that's the case, that's going to give a nice surge in the market towards that last part of the year. There is some strategy behind that. Like right now, we're wrapping up a bunch of projects ourselves. I'm actually looking for a little bit bigger projects rather than quick ones, because I want to hit that quarter that's going to have the lowest possible rate. Even though we'd be in more of a winter slow month, the cost of money is offsetting the seasons right now. And so if I can land my deal with the cheapest possible rate, that's going to get me the highest exit price and possible upside for the values that I'm seeing right now. So impacts from rates. As rates keep increasing, or we've seen them increase, we're just going to have longer market times, and that is okay. One thing that we're doing at our office is we're just adding more time in for debt costs. Factoring it only is bad when you don't factor for the time, if you undercut your pro forma. So we know that it takes 30 to 60 days to sell a house now. Then we just need to adapt and change from there. Other things that we're seeing on the impacts from rates is we're seeing sudden drops in some neighborhoods because there could be that one seller that wants to, they have a little bit of FOMO. They want to get rid of their house. They made the decision to sell. They feel like they missed the market and they don't want it to continue to decline. So we have been seeing some irrational price drops, and that's not good when you have one of your houses for sale. If all of a sudden a person takes 100 grand off list or 10% off list, it can make the neighborhood kind of drive backwards. So that has been affecting things. Buyers are very selective right now. They want to take their time. We on some of our listings, we've had buyers come back 7 or 8 times to the same listing, and we're just trying to get them to write it. And they're almost there, but they really want to keep exploring. They're paying a lot more on their mortgage cost. Their monthly payment's way high. They want to make sure that they're getting into the right house. And also they have the time, so they're going to take it. And then showings have reduced about 90% in the past 90 days. So about 90 days ago when we were pricing things, we're getting actually about more like 4 to 6 showings a week. So now that we're kind of floating in that 2 to 3, it's been a definitely sudden drop. But the buyers that are looking are typically pretty good buyers. They're people that want to get into a house and they're ready to pull a trigger. Luckily for us in Washington, we have a lot of transplant, a lot of reload people, and they need housing. So what are we doing at Heaton Dainard? So it's all about underwriting and kind of padding and protecting the performa. So we're, like we said, days on market are up. So we're increasing our holding times on deals that we used to factor for 5 to 6 months worth of hold. We are going at 7 to 8 months. So we're adding about that 50 to 60 days. We're adding construction contingencies into all our budgets, just in case we get some more creep in the cost around here. In addition to, it's always better to over budget because then you just have a little bit of padding in your margin. We're using cluster comps. We're not going for that high comp. Where is the activity? We want to put together the right plan, and we want to value the property with where the most buyers are. That is the key to flipping homes. You don't want to be the one outlier house. You want to be in where the action is. In addition to, if we're fully renovated and the property's been updated, it's going to make, if we're priced around the same pricing as homes that maybe aren't quite as updated, it makes the transaction go really quick. Back in 2008 and 9, we were flipping a ton of properties and our average days on market was like around 30 days. Whereas in those specific cities, the days on market were like 100, 150 days. We were able to sell these homes a lot quicker with a lot more supply in the market because we would just go to market with the cluster and they were getting the best possible product. There's always a buyer for that. For comparable analysis, we're using only recent sales that are 60 days old, or we kind of go back to figure out when rates, like if we're going back and we're using comps where the rates were actually in the 7s, I feel good about that too. But we're using comparable data that has the same type of interest expense. So we don't want to go back too far. Obviously, spring comps are not relevant anymore. And then we're having a heavy emphasis on pendings active values. We want to know where the current action is. If a home sold 45 days ago for $1 million and now the other 3 pendings are all at 950, then that's what the trend's doing. We got to kind of go to that 950 trend. So again, we're calling every broker that's got a pending. We're finding out kind of where they're at on their sale prices or where they're close to. And then we're kind of using those values from there. And then we've increased our returns to where we're looking at 16 to 20% returns, which equates out to about 40 to 45% with leverage. So adding more potential profit into the deals, padding your performas, and we're able to get the right buys. I will say the opportunities have slowed down on your basic straight over tackle, fix and flip. A lot of sellers haven't got to the pricing that they need to get to offset the heavy construction cost and the market decline. And so we are seeing less transactions. If you're a client of ours and you haven't seen that much inventory recently, it's because we're being really, really selective. It's more important for us to get you guys good deals than volumes of deals. And so don't be concerned, but we have all sorts of different, we're using a company called EasyButton leads to get us more off-market opportunities. We're seeing more on-market opportunities come up, and we really just want to make sure we're getting clients good buys. So if you're not getting a call from us, it's because we're not seeing anything in the market. What we are seeing on the trends for better purchases is the single family heavy fixers. Those margins have all jumped dramatically. The reason being is it takes a long time. People don't want to be in a deal for a 9 to 12 month period, even though that's actually could be a benefit this year, right? You'd be getting into lower rates at that time. And then also just with the construction, construction has become pretty painful the last 12 to 18 months to where a lot of investors just kind of got burned out on these construction teams. And so they're taking a break from the heavy fixers because they don't want to go over budget. They don't want to get stuck in permits. They just want to get in and out of the market. But because so many people have left that market, it has really created some opportunities to where I'm targeting those heavy fixers because there's less demand, which means a better buy. um, Development land, stuff for cottages, single family scrapes, townhome dirt. The pricing has came down 35% to 40% from peak. Also, sellers are more willing to give you a little bit longer terms. So the fact that you can buy this land for 35% cheaper than you could 9 months ago, there's a lot of opportunity there as well. Small and large multifamily, we're seeing a very low demand. And so there is inventory in the market. It's still priced kind of heavy for what the current rates are, but there is those deals that are getting done. I know we've locked up and we just contracted a syndication deal that we're going to be wrapping up in about or closing in 30 days. It was a great buy out in Federal Way. It's, we're getting about 2 points higher on our IRR than we were getting 6 months ago. And so the deals are there. You just got to be patient and just be diligent about getting through them and taking a look at them. So forecasting, we are forecasting a slow first quarter. Rates, we have seen a pickup in activity, I would say, the last week or two. Like buyers did come out. The seasonal slowdown was a real thing this year, which we haven't seen for the last 2 years. But we are seeing buyers come out. But rates with the Fed raising rates a little bit more, and they're going to kind of get to their sweet spot. We're going to see that kind of slow quarter 1 and 2, and that's okay. I believe that in quarter 3, we're going to really start to see things kind of normalize and the transactions picked up. And by quarter 4, I do think that rates could be in the fives and we could be getting back to a normal amount of absorption, a normal amount of purchasing. Inventory is still really low right now for historically. And so if the money gets cheaper, that could cause the market to kind of surge up again towards the end of the year. We do believe that rents are going to flatten out. I don't anticipate too much of a decline in rents unless it's kind of that upper echelon, more expensive luxury market. I think your run of the mill stuff that's in that median rent price is going to be fine. One thing that you can do if you're looking at rental properties is look at the cost to rent or cost to purchase versus cost to rent ratio. That's a good way to look at things on whether they could decline or not. If the cost to rent is if the cost to rent is versus the cost to buy is substantially better to rent, that's usually where things hold tight and keep increasing. And many of those South King markets, Snohomish, it's still a really good ratio. Um, and so those are things that you can look at to see if you're going to kind of project any kind of decline. Um, Multifamily, we're anticipating more buys on that side. The larger deals have definitely been a little bit out there. The small multifamily still priced a little heavy. We are kind of looking at a few different opportunities and we've been able to kind of trap them recently. I will say the multis that are listed low right now, 2 to 4 units, they're still getting a lot of activity. I mean, there was one that we just wrote an offer on that we thought were going to be pretty competitive on and it had 14 offers. And so if things are priced low, they do move quickly. So as an investor, don't get too caught up on I got to steal this property or I need to offer lower just because that's what the market's doing. Stick with the performa, go with the offer that makes sense inside your numbers. And then opportunities are going to continue to arise as the market gets a little bit more difficult. So forecasting investments is still technically a seller's market right now, but you got to be patient. Don't press your price up too heavy as well. Opportunities are increasing. So if you are sitting on capital and there's all sorts of different types of opportunities right now that are out there. You just might need to adjust what you're buying. I know the amount we've bought more property in the last 6 months than we did the last 18 months on a volume side. The types of property that we bought were completely different in the last 6 months than we did 18 months ago. And so each market gives you different types of opportunities. And so just make sure that don't get too laser focused on what you've been doing the last 24 months because that might not be the right plan. There's other plans that you can get involved with. There's other things you can be looking for that you can really get some good buys on right now. Single family heavy fixers, margins are increasing. Development, like we talked about this, is down 35% for peak. So there is a lot of good different opportunities out there. So for more information, guys, you can, if you haven't been to our investor 101 class, we just did one last night. I teach it once a month at our office. Make sure you come by, talk to us. We'll kind of go over how our business works, how we underwrite things, how we analyze deals. In addition to, I like to get you in for a one-on-one and kind of figure out how to help you with this kind of crazy market and getting your investment goals met. But for more free education or for market updates, you can check us out on Instagram at Heaton Dainard and J Dane Flips. YouTube is at Project RE. And then make sure you also check out that Bigger Pockets on the Market podcast that I'm a host on with an awesome group of people. Really thankful I'm on that. It's like the highlight of my week every time I get to hop on with my friends. But make sure you check it out, guys. We talk about trends, forecasting, and what's going on in the future. Buying on the now is not always smart. You got to buy on the come. So make sure you dig all into that. So now what we're going to do now is we are going to open it up for questions. I'll answer the questions until they're done or for the next 25 minutes. What you have to do in our fancy studio premium box or whatever this thing is. You just got to throw your questions in the chat box and then I will answer them accordingly. Mark's car. Good morning. Good morning, Mark. And you guys, the questions can be about anything. It doesn't just need to be about the Pacific Northwest market. Open this up for questions. If we don't have any questions, I will jump off pretty quickly because there's deals to look at. Any questions, guys? Oh, good question. Mark says, are you tracking any employment data? We're definitely looking at, things to always look at are what's going on in your local market. So yes, I do a lot of research locally at what the tech companies are doing. A lot of the product that I'm buying or renting out does go to that tech demographic. And, so I do want to know, like, what's the anticipated layoffs? I will say a lot of the media, it makes it sound kind of nasty, but then if you really dig into who they're laying off, they really weren't our demographic that was buying anyways. So yes, we do want to know where the job growth is, how many people are they hiring, what the average income is, and then if we're seeing mass layoffs in Seattle, yes, we're going to be very cautious on pushing rents or maybe even factoring in a little bit of a decline. Same with values or anticipate longer market time. It's really important to track that kind of data and what's going on in your local economy. Eugene asks, currently investing in Nebraska, but taxes and lack of appreciation make me consider investing in Washington State. Yeah, and that's an investment strategy. There, United States has so many different types of market that offer good things. I am a Washington State in my backyard type of investor. I've only bought in properties in Washington. Well, I've done some passive investing in a couple other states. I invested in a syndication deal in New Mexico. Have flipped some properties in Arizona. I actually plan to do that again. But there's each market offers different things. If you're in Nebraska or those entry level markets, they're really good to get into your first deal and try to generate some cash flow and start building out your portfolio. There's lots of opportunities there. The reason I like the Pacific Northwest or these West Coast markets is we can get that massive appreciation kickers that can really change things. A lot of times we're not buying really based on cash flow. It could be a very minimal cash flow. We're buying on the equity position increase because what we like to do is chase that big equity gain. That is our portfolio builders. Like right now, I have a property that has great cash flow in Queen Anne. I bought it. It was really cheap. Building was terrible. It needed a ton of work. I paid like $380 for it. I put $200 into the renovation, but now it's worth $800,000. Now, once I refinanced that property, I got all my capital back out of it. I'm cash flowing over $1,000 a month. And so that's a great buy. But really what I bought that property for wasn't the cash flow. I bought that because now I have a $300,000 equity position that I can 1031 exchange later and take these 2 doors and trade them into 6. And that's where, and I can, in addition to, I can buy a value add 6 unit. And so what that does, it allows me to increase my net worth, increase my overall wealth very, very dramatically and quickly. There's nothing wrong with buying a high cash flow property, but if I'm going to make, let's say I'm making 400 or 500 bucks a month on a house in Nebraska, which has a lower appreciation market over a year period, that's 6 grand that I'm going to acquire. At 10 years, that's roughly going to be 60,000. Then minus your expenses plus some upside, you're probably going to be around 45, 50 grand after 10 years. Whereas in Seattle, I can come in, get that instant discount and get into $100,000 equity position by doing the right rehab plan, and I can trade that later. So instead, and not only that, I will get some cash flow out of it, but it's that day walk-in equity that can really change things around. Danny McClinton asked, for seller financing a deal, do you only need lawyers? No, you don't. I would say it depends on the state that you're in. I don't want to quote legal advice that I don't know. I do know for seller financing in Washington State, we don't need lawyers. Our escrow company can do it for us. They'll prepare a deed of trust and a note with it, so you don't technically need it. I would highly advise that you do have a lawyer do it, though. It's always good to make sure the terms are all laid out right and everything's recorded correctly. And always, guys, make sure, I've seen on some seller financing too, people don't get title insurance. Always get title insurance. Eugene writes, is there a good tool to analyze profitability on a more detailed level, including property taxes, insurance, property, and appreciation rate? Oh, yeah, Eugene, that's a great question. So we are 2023, we are doing a big push to give investor tools. And we are making 6 new financial calculators for investors. And we're going to make them very simple so they're easy to use, easy to input in. Those will be on the Project RE website in the next 2 weeks. So, sorry, not the Project RE, the jamesdainard.com website. So go to that website, jamesdainard.com, make a login if you haven't done that already, sign up for it. It doesn't cost anything for now. And we will have those calculators on our website. Red Full Circle, how are you? It says, with your experience, what is the shortest time you can hold a 1031 exchange? Is it 2 or 5 years? I have 2 houses in Florida. As far as I know and how I've done it is I need to have that property as a rental property for a year and a day. 12 months is the threshold because then it goes to a long-term gain too. But I've done that numerous times where I've sold that property like literally 2 days after. I know there's one in Kirkland I did. I sold it at the wrong time. I probably should have kept it, but I bought this property as a rental just to get the equity out of it. I got a huge equity gain. Oh, that's what I traded my duplex for later. And so I'm always trading them out. And typically, if it's a single family house and I'm not getting that good of cash flow, I want to maximize the equity as quickly as possible. Eugene says, thank you. Does your team source and fund investment property in Vancouver, Washington area? Eugene, yes, we do. So definitely reach out to us. Come to our Investor 101 class. We do it if you're down in Vancouver. I know it's a long drive up to Bellevue, but we do them online as well. We had an online one last night. Intrust Funding definitely funds deals in Vancouver, Washington. So go to intrustfunding.com. In addition to, we do get off-market deals down there. Actually, we've been getting way more deal flow down that way than we have up in King County recently. So reach out to us, shoot us an email, and we'll see if we can get you taken care of. Josh says, do you have a scope of work checklist available on your website? Yes, it is coming. All the documents will be loaded to our website, you guys, I would say by the end of the month. So we have a punch list document. We have a walkthrough checklist. We're building a really cool construction calculator, a simple one and a more complex one for project management. So definitely check out that website. Red Full Circle says, taking a break from fix and flip while you sell off our inventory. Do you think wholesaling is oversaturated? I think it's a good thing to get through your inventory. I know for us, we slowed down on buying for a little bit on the fix and flip as well. Not because we were concerned about the market, more because I just wanted to get my guys through and control our cost. I think there's there's a lot of assumptions that because we do a lot of projects in Washington that we get the best possible pricing, which is not true. Actually, the more projects you have, the more issues you have. And so I did that just to get our books cleaned up, and we have some expensive properties coming up, but we are actually getting ready to buy right now. So I would say don't take 100% break from fix and flip. Just put the number that you would buy a deal at it. Because even when I was cleaning up I wanted to get through a chunk of our deals because we had about $15 million in fix and flips going on. So I just wanted to get through them. I still bought 2 properties during that time, and the reason being is I just had a certain return that I was like, "Well, if I can get it for this price, I'll buy something." And so don't make the mistake of not doing any, just put a really good number on it because then you're actually getting the killer buy. I do think there's a lot of wholesalers out there, but that doesn't mean that it's oversaturated because a lot of wholesalers don't have the same work ethic as some other ones. And no matter what, if you grind on it and you will get deals done. We're still wholesaling deals right now, even with it being oversaturated in the Washington market. So as long as you're doing good business, you can get it done. A lot of guys are just kind of floating around right now. So it's actually a good opportunity to get into wholesaling, get your systems down, and then and because if you do run your business right, the sellers work better with you, the investors work better for you, and it kind of actually takes the guys that don't run it right out of the market. All good questions, guys. Any more questions? Another question is if you had to pick becoming an agent or get into sub two with the goal of build wealth and get deals to grow your rental portfolio. Um, so if I had to pick between being a broker and investor doing sub two or maybe wholesaling sub two, I would say what's your passion? You can also do both. Um, we are a company that does both. We have our brokerage that whereas we operate as investment advisors into secure on-market investments. We also have an off-market company. So with the right systems, you can definitely do both. You can also, like as a broker, if you can find a deal, that's how you can get an investor into it. So you can package that up. So I would say explore. If it was up to me and if I could turn back the hands of time, being in the broker business that's an income generator. You're in the service business. Financial freedom is about not being accountable to anybody. And when you are a broker, you are accountable to your clients. And so that's something to keep in mind. There's nothing wrong with that. Watching people grow as an investor is an awesome, amazing thing. We've seen tons and tons of investors start from scratch and now they're very, very successful. And it's an awesome thing to watch. But also, it's a lot of work. And I would say if I turn back the hands of time, I would have done both just to generate income and get to that end goal of wealth. If I was doing it today, I would be more passive as an investor because that's what I'm trying to be is just a fully passive investor down the road. But I still got some years before I get there. Another question is, do you think there will be a buying opportunity in the new construction homes like KB Homes, DR Horton, etc.? I understand it's a location dependent, but the general perspective. Okay, yeah. So a lot of these track builders, the big guys, I don't think you're going to see many issues with them. A, they made a ton of money the last 24 months. B, they're funded a little bit differently than a lot of these smaller builders, and there's a lot of equity in those deals or private equity. I do know that they're liquid enough to where some of these big builders have bought big plats and they go, well, we're just not going to build them right now. They're just going to land bank the lots. So I don't think it's going to be the big plats. I do think that there is going to be a lot of opportunity in the small developer because, a lot of investors went from fix and flip to building, and that's a big learning curve. We've learned those learning curves. There's always stuff that you don't know that they can creep up on your pro forma. In addition to, if you didn't evaluate those correctly, those have came down, you kind of get double stung. And so I do think the spot lots, you're going to see some opportunities like properties half built, maybe properties a little over leveraged, private financing. I do also think there's going to be some opportunity in the fix and flip space for properties that are half renovated, maybe over leveraged. The leverage position that people were getting about 12 months ago is, lenders weren't requiring very much down, which was not normal. Typically, since I've been doing this business, hard money is 15 to 25% down. Then what we started seeing was 5 to 10% down. And then with the market coming back 10% and cost increasing and people also with those learning curves, you're going to get these properties that are over leveraged and not stabilized. And I do think that there is going to be some opportunity there. Any more questions, guys? Well, hopefully everybody likes these market updates. I know we kind of started doing these out of the blue about 6 months ago, but we're going to continue to do some. Also, guys, if you're local investors, we're going to be doing a lot more meetup groups at properties. I know we're going to schedule one for our farmhouse luxury flip that we just listed for 3.2 million. I'm going to walk everybody around, let them know kind of what the differences in finishes and what your cost should be. Also, differences in trade costs, and kind of go through that. In addition to, we have one in Capitol Hill that's going through inspections right now. We're going to have everyone through a big rough-in kind of roundup and walk through. So be on the lookout for those email invites. And if you're not in our email system, make sure that you go to heatondainard.com and sign up, because that will give you all the notifications. Another question is, do you suggest learning to do you suggest a learning source to learn how to build a foundation of your business for wholesaling? I know there's a lot of YouTube universities and other charge for their platform. Yeah, if you guys are looking for free is YouTube's probably the best for that. Jamil Dandy, who's a good buddy of mine, and he's on the Market podcast. They have an awesome wholesaling group. He's with Pace Morby on there as well. It's Astro Flipping and Subject to. Those are good ways to go. We're going to be on Project RE. We're going to be launching a wholesale platform for a monthly subscription fee. It's going to be an all-inclusive investment kind of school, but we are going to be going deep into that. You can go to our Project RE YouTube. I would say there's two things that you should watch on there. One is how to underwrite your deal video, because that's going to tell you how to refine your skills for wholesaling. And then we have a few different wholesaling videos up there and on Bigger Pockets. Those are all free that you can download as well. But if I was to sign up, I would say, and then Cole Rudd Johnson from Equity Pad is another guy you should be following on social media. He gives a lot of free information as well, and he's really sharp when it comes to analytics, data, and processes. So make sure you check out Jamil Danzy, Pace Morby, and also Cole Rudd Johnson on social media. Lots of free information there. You're welcome, Josh. So you guys, we are launching this quarter two. So this is in less than 60 days. We will have this educational kind of platform. We're finalizing it right now. It's not going to be very expensive. We're trying to kind of prioritize that we're not charging a ton for this, but we do need to cover our costs. And what it's going to be is I'll be teaching once a week on a specific topic, how to do it. The membership will include all of our contracts, forms, scripts, everything on there. And then as we're evolving our business, that will always be loaded in. We thought about doing individual courses, like, 4 or 5, 8-week courses. We still might go that route. I'm finalizing that this week. But I kind of like the community base, to where we can just, every quarter, every year is different. And so we're adjusting and pivoting our businesses. And so, like, what we're going to teach you today in wholesaling might look a lot different in 12 months. And so that's kind of where we're starting to think about more doing the community, and just we can be friends for a long time that way. Well, I want to thank everyone for coming out. We will be doing this again next month. I appreciate that, Red Circle. Yeah. You guys be on the lookout. We're doing a bunch of cool things in 2023. Hired a new sales manager, Quasi. He's actually in my office right now. We're at Heaton Dainard. We're also launching a bunch of new sales departments too. So if you're a broker and you're looking for a landing spot, reach out to us. We will be having some new job openings. And then for investors, we're going to have a bunch of different products and services for you. So 2023 is going to look a lot different than it did the last 10 years, but all really good things. Oh, one more question says, do you think there's still an opportunity in house flipping with the interest rates being so high, where buyers, in a way, get priced out? I've seen some flips get price cut after price cut. Oh, yeah. I would say if you bought any flips, including myself, and trust me, we bought a lot. If you bought, it's all based on data and analytics. And so, unfortunately, the first 2 quarters had bad data. We saw massive appreciation of values that were established that now have came backwards. And so the price cuts on these flips are coming from because a lot of these guys are pricing it based on their spring comps because that's how they evaluated it. Whereas as an investor, you guys, you want to price in today's market. I know that doesn't sound awesome right away, but if you want to move your deal, debt costs can erode a deal, time can erode a deal. When I'm pricing a house, I'm not looking about how much money I'm making or how much money I'm losing. I'm pricing it based on market conditions and whether I want to keep it or not. And if there's certain homes that I'm going to look at that if I can keep them, I might keep them because they have some upside. And if I bought them to sell them in the pricing, like I have two flips that I just listed, one at 3.2 and another one I'm listing at 4.5 million. Both are great properties. I'm actually not too concerned with them. Those are properties I can't keep and rent. And so no matter what, they are getting sold. And when I price them, I'm going to price them in the current market conditions, not what I put on the pro forma. So that's where you see your price cuts. Yes, you can still flip in today's market. We were flipping in 2008 when the market was rapidly declining and we were getting deals done. So just make sure you pad those pro formas, you put that extra margin in, and you can still buy it. Because the one thing is, Danny, if everyone's thinking you shouldn't flip, that's where the most opportunities are. If you're doing what everybody's doing, that's where you're not going to make any money. And so I would say still do it. Still look at that as an avenue, but make sure you define your buy box and to know what is a deal to you. Because what a deal to me is going to look different than a deal to you. I probably have a much higher appetite for risk than most investors. In addition to, we're buying different types of product at that point. But you have to define your buy box. And if it hits that magic number, buy that deal because you can still make money on it. And as long as you're not pressing the pro forma, you can get in and out of it. Data, guys. It's all about the data you're using. And verify your own data. We're an investment company at Heaton Dainard. We pride ourselves on tight underwriting. We still tell our clients to verify our underwriting because everyone's opinion is a little bit different. Like me and my business partner, Will, we've been partners for almost 20 years now. I'll look at a deal one way. He looks at it a totally different way. And that doesn't mean him right or wrong. It's just getting feedback and putting the right plan that works for you on it. Cool, guys. Well, we just hit the hour mark, so we're going to wrap this up. Again, next month, we'll have another market update. We'll talk about the first or January, what happened there, what the trends are going into this next quarter. It's going to be really important to track these trends for the next 4 weeks. And then be on the lookout. Make sure you're on our database. We will be sending out more kind of live event stuff that we'll be doing. And I want to thank everyone and enjoy your week.